Good evening, ladies and gentlemen. My name is Anne-Marie Butler. I'm the President of the Agricultural Science Association, and I'm delighted to welcome you to our evening webinar this evening, Financial Fitness for the Ag Scientist. On behalf of ASA, I'm delighted that you've taken the time to join us. We've had great numbers in registration, so hopefully everybody takes something from this evening. I suppose personal finances, family finances, business finances are certainly something very important for us all, and I think there's always something for everybody to learn from that. I would like to sincerely thank FBD for their continued support of ASA and for their generous association with this event tonight. ASA are delighted to work with FBD, and we have a long-standing relationship, and we are very much appreciative of that. I'm delighted tonight to be able to welcome both John Mulholland and John Lowe from moneydoctors.ie, who will be addressing you on a variety of topics right across personal finance spectrum. I would like to sincerely thank ASA Council for their work in bringing this event to you, and to thank Council Member Odile Evans, who will chair the event. At ASA, we always look forward to hearing from our members, so please don't ever hesitate to get in touch with me. It's president@asaireland.ie, or give a phone call to the office where Barbara will be more than happy to chat to you. We're here to serve our members, and we're here to add benefit for members, so if there is anything that we can do to assist, please don't hesitate. If you're not an ASA member, we would certainly be delighted to chat to you and welcome you into the group. Plenty of benefits for members, and always bringing the most recent science and most pertinent issues right to your home on the current environment. But we look forward to face-to-face events once vaccines roll and we're all back to a more routine and normal world. I would like to thank Barbara in our office for her support and for her technical assistance in bringing events like this to you tonight. If I can just call out, our ASA podcast, Experts in Their Field, is available to all. We have a monthly podcast that comes out where we have a chat with an individual who has a strong link with agriculture. We have 5 already podcasts out, and our January podcast will come out at the end of the month, and we'll have one for the rest of the year. So I do encourage you to have a listen. But for tonight, financial fitness, please do enjoy. The Q&A function is available, so please do post your questions, and I will have lots of questions at the end. But get the questions in, and we'll certainly take them. At this point, I'd just like to hand over to Odile and to thank Odile for chairing the event.
Thank you, Anne-Marie. So without further ado, because I'm sure everybody is here eager to find out how they can better manage their money, I'm going to introduce the first of our 2 speakers tonight. And our first speaker is John Mulholland. He's a senior financial advisor with FBD Insurance, with more than 10 years experience in providing expert financial planning advice to clients, specialising in the areas of pre- and post-retirement planning, wealth management, family and income protection cover. John's first presentation tonight is going to cover the areas of human and financial capital. I'll hand it over to you now, John.
Thank you, Adele. Good evening, everybody, and thank you for tuning in this evening. I hope you're very well. And as Odile has said, I work with FBD Insurance. I'm a financial planner with FBD, and I have worked with them for a number of years. So we're delighted to be able to take a time this evening to spend with yourselves and give you an indication, I suppose, of what we can do in terms of protecting you from a financial planning point of view. I have 2 presentations for you this evening. The first one is in relation to human versus financial capital concepts and how that relates to financial protection planning. And then the second part of it then is in relation to retirement planning as well. So I have a little presentation which I'm going to go through now. Don't be afraid to go on the chat function and ask any questions as we go through this, and I would be delighted to answer any questions that you have. So without further ado, I'm going to go on to it now. So in terms of this is obviously myself. I'm a qualified financial advisor, retirement planning advisor, specialist investment advisor, and a financial advisor with FBD Life and Pensions. In terms of a little piece about FBD Insurance, for anybody who's not aware of what we do, FBD Insurance is Ireland's largest Irish-owned insurer. We look after our customer insurance needs for home, car, farm and business. So what we would term the general insurance side, that's the cornerstone or the bedrock of FBD itself. And we've been protecting our Irish customers and communities for the past 50 years. FBD also has a team of expert financial advisors, including yours truly. We're based in our 34 local offices across the country and located throughout Ireland. So in terms of what we do as our financial advisors, we provide advice on all retirement planning, protection and investment options by reviewing your existing arrangements to establish if your current needs are correct and if you're getting good value for money. Ensuring you're invested in areas that strike a balance between potential return and capital security. So sorry about that, folks. In terms of the slides itself, then the first piece here then in relation to protecting your financial future, the human capital concept. What is human capital concept and what are we talking about here? The importance of human capital in the context of deciding the requirement for and the level of life for it, it really can't be understated. So what is this and why is it so relevant? Well, human capital is a calculation of the present value of an individual's future income. So in terms of when we sit down and talk to our customers in relation to life cover, for example, a lot of times what we're trying to do is calculate what level of cover somebody should really be considering. And one of the things that we think, when you think about life cover, a lot of times what people are trying to do is protect their ability to earn future income. So in terms of the human capital piece, if you're a recent graduate, for example, or in the early stages of your career, your present salary may not be fully developed compared to your qualifications, etc. But you should have potential for a long period of earnings ahead of you. Therefore, it's said that your human capital is high. Alternatively, if you're the other side of the spectrum, perhaps if you're a little bit older and you're well established in your career with less of your actual working life in front of you, but you've had real wage growth during the working life, and perhaps you've accumulated assets, for example, in the sense of property or pensions, etc., it's said that your financial capital is high. So what we try and do in this situation here is compare where you are in the human capital piece as opposed to your financial capital. So I have a slide here which might just show the difference between the two or how the two correlate. Now, this is from the sources. This is from the graduate diploma in financial planning or a risk management module. So this is a graduate diploma that I just completed late last year. And in terms of what this slide seeks to do, it gives you an indication in terms of, if you look at the human capital piece, this is this line here, the blue line here. And what we're looking at, we'll say a typical person might start their real career or their first, to use the phrase, proper job at the age of 25, and typically run till age 65, although, that might be changing in today's environment. But that's what we work at from a human capital point of view. And the idea of this then is to give us an indication of where you are in the spectrum. So if we take, for example, the financial capital piece, you can see as we get older, our financial capital is probably increasing. Maybe our wages are increasing, our loans are decreasing, and then there's a correlation between the two. So in terms of our human capital piece, the younger that we are, the better chance we have of earning a future income. But obviously, the older we get, the less scope we have to earn that income. So it's important to have an idea in terms of where you are within this particular spectrum of ages when it comes to considering life cover and other protection options that go with it, because it might give you a good indication in terms of the level of cover that you should be considering that situation. So using this concept, how much life cover do I need? Well, typical needs for heads of household in relation to life cover. There's a few things that most people should automatically consider. You need probably funds to bury you, pay off your mortgage, and leave your short-term finances in order. They're absolutely probably critical parts of where anybody comes from a life cover conversation point of view. Along with that, it's probably important to provide sufficient income for next of kin to maintain their quality of life and also protect future income needs. So you might have young children at this stage, so they might need to put money aside for college funds, house improvements, and so on and so forth. But these are the sort of things that people need to consider when they're looking at life cover needs. Allow for the reduction in income as a result of additional tasks falling on a one-parent household. So if people are working off a two-parent household, it means that day-to-day tasks are shared, income is shared as well. Obviously, income coming into the household if both parents are working. There's a lot of correlation in terms of what happens in a one-parent household and reduction in income. So it's very important to take that into consideration as well. So what type of product should I consider to meet these needs? So what I'm going to do here is I'm going to go through a couple of basic covers that most people should consider and look at depending on their current situation. Each of these covers will protect a particular financial need. For example, mortgage protection cover. It's a simple one, this one. The way it works is a policy that will clear your outstanding mortgage in the event of death. It's typically arranged as a decreasing cover joint life policy. Typically, the amount of cover reduces down as the mortgage outstanding decreases with joint life, meaning any payout is on a first death basis. So all these policies I'm talking here is based upon a joint life, or in other words, two people being on the policy. In that situation where the mortgage protection cover, if two people are covered, and one person's unlucky enough to die, in a mortgage protection situation, the money is paid out and it goes towards clearing the mortgage. In terms of this type of policy, common things that I would see is that most people take this cover with the bank alongside their mortgage. My view, if that's you should think again. Obviously, a lot of time for simplicity or for a sense of quickness, somebody might be in a situation where they're drawing down the mortgage. The bank offers this type of cover and they say, well, why not? Why would I not just do it with them? There's a couple of reasons I would probably question or think about that decision. First one, the banks are tied agents for life cover, pension, and investment products, meaning that the policies they provide are limited in choice to one provider. So all banks work with one insurance provider to provide these needs. It means that the product that they offer then is very limited in the choice, in that in the sense that it's just one company that's going to be on the table in that situation. The best thing to do to avoid that is to engage with a broker to quote you for the amount of mortgage cover you need and then compare with the bank's offering. There'll be only one winner in price in that situation. Obviously, there's actually 5 different insurance providers in there that provide mortgage protection cover. So in that scenario there, for most brokers worth their salt are able to check and review all those different insurance companies and what price they would charge for mortgage protection cover. In terms of value for money, then that's going to be a huge win from a customer perspective. Another thing I would say in terms of mortgage protection cover, you can also review your existing mortgage protection cover with a broker to see if it still meets your needs. Often huge savings to be made here. What I've seen in the past in relation to that is that people might have mortgages, maybe they've reduced down what they owed in the mortgage by paying a lump sum off it. They might have stopped smoking. They might have shortened the term in the mortgage. There's a myriad of different reasons why the existing mortgage cover that you have mightn't be fit for purpose anymore. So this is what I'm talking about in terms of reviewing that to ensure that you have value for money in that situation. The next policy that we're going to look at, the type of policy we're going to look at, is life cover. So the way life cover works then is that it pays out a tax-free lump sum to your chosen beneficiary in the event of your death. Very simple policy. It essentially creates a lump sum of money out of a tragic circumstance like a death. Typically arranges a life cover dual life policy on a term basis. Generally, the amount of cover remains the same for the lifetime of the policy. Dual life cover means that if one person dies and a claim is made, life cover still remains on the surviving partner for the remainder of the policy. So there are 2 very important pieces that make it different from mortgage cover. The first piece is the fact that the amount of life cover stays the same. It doesn't reduce down as the term of the policy passes by. So if I'm unlucky enough to die 15 years into my policy term, I'll still be covered for the amount of cover that I took out in the first place. While dual cover obviously means that there's a double payout potential in that situation. So if, for example, it's a married couple or a cohabiting couple and both are covered under the policy, 2 payouts are made in the situation of, God forbid, of both people dying. In terms of life cover, there's some good news here. Life cover policies have never been more competitively priced than now, with companies actively trying to gain market share. What we are seeing out in the Irish market at the moment is that there's very, very robust pricing being put in place by companies. Not only are they doing what's called price matching, which means that they'll take the prices of other companies and match that. They might apply further discounts to that price. They may include 3 months cover. So there's a lot of different ways where you'll see a pricing and life cover aggressively and very competitively being pushed down. I think that's the way the business has gone. I think it's very, very good news for the consumer, obviously, because it means that they can see good value for money. But it's important that in order to avail of that you know where to go or how to go about achieving the best value that you can. When in terms of the life cover itself, then some of the things that people need to consider when it comes to the amount of cover. We've obviously talked about the human and financial concepts. Other parts that come into play are, for example, are you single, cohabiting, or married? The person who's generally cohabiting, married, and do you have dependents? So the person who has that sort of stuff going on in their life, they're probably more attuned to the fact that if something happens to them, there's a requirement to perhaps protect their family in that situation. What ages are your dependents? So if they're young and very, very much under your wing in terms of you providing day-to-day care for them, it's absolutely crucial, I think, that something is in place. There's a fallback plan in place in that scenario. One thing that people often might fail to recognize, you may have what's called a death and service cover in your job. So, for example, a lot of larger companies will offer the ability to say, well, if you're working in our employment and you're lucky enough to pass away, there will be a multiple of your salary paid out to your next of kin in the event of you dying. So a death in service, absolutely crucial that people are aware of it within their employer. And also one other thing in relation to that if you have it, that you've made sure that it's assigned to go to the correct person. So you may have started employment years ago and your circumstances may have changed. So it's important to review that with your HR to see, is the death in service still going to the person that you would like it to go to if something terrible was to happen. Another consideration, will your partner be able to continue to work full-time if you're gone? So, if there's a two-parent family with two incomes coming in and suddenly that goes down to one, well, first things first, the income is lost. But the second thing in relation to it is the surviving partner may have a whole load of additional responsibilities on a day-to-day basis, which were shared before this. That can make it absolutely very difficult to continue on working in the same way that perhaps they were before. So it might be, I suppose, a lifestyle choice in that situation to be able to provide a life cover to give somebody the peace of mind to know that I can take time off work. I am able to step away from my responsibilities and my job to look after my family when something like this happens. Another question is, what about guaranteed cover? What that means then is that a lot of cover out there has the ability then to what they call put a guaranteed cover or conversion option on it. How that works is that it allows you to put a policy in place with a clause on it or a guarantee on it that at the end of the policy, say for example, the policy was 15 years in length, at the end of the 15 years, you'll be able to put in place a new policy for the same amount of cover without providing further medical evidence. A very, very important piece of, I suppose, a little niche to include in your policy when you're considering this thing, because as the years go by and you could be unlucky enough for some sort of medical condition to apply or occur, which can mean securing new cover can be difficult in that situation. That's where the guaranteed cover would come into play. You'd have absolute peace of mind in that scenario. So again, in my advice in this situation, if somebody is considering life cover needs, engage with a broker, tease out the considerations out and get them the price to cover you feel is required based upon the conversations that you had, based upon your answers to those questions, based upon where you sit in terms of your human versus financial concepts. I suppose reviewing your existing life cover with a broker to see if it still meets your needs is also a great idea. That just goes without saying. If you're not reviewing your policy on a reasonably regular basis, you may be missing a trick in that scenario. So I'd emphasize that. That's our life cover side of things. There is a couple of other protection covers which I felt might be of relevance or use to yourselves as ASA members. First one is what they call serious illness cover. This is a policy that will pay out a tax-free lump sum if you suffer from one of the serious illnesses that are on an insurance company's list. They're typically arranged as a life cover, dual life policy on a term basis. So serious illness cover came into play a long number of years ago. And what has happened is that the companies have a list of illnesses that they will pay out an amount of money in this situation. So generally speaking, the amount of cover that is picked. If somebody's unlucky enough to suffer one of the illnesses that are on the list, the payout is made in that situation. Payouts are tax-free and are paid as a lump sum in that scenario. Often this cover is attached to, included with your life cover and or mortgage cover. If it's with your mortgage cover, it's more than likely a decreasing cover policy. So be conscious of that. If you do have a mortgage cover in place with serious illness cover and you think you're sufficiently covered, it's important to recognize that that serious illness cover is reducing down all the time. So when considering serious illness cover, think about the needs for cover. Very similar to life cover. Are you married? Do you have dependents? What ages are they? One piece then in terms of your job, do you have income protection with your job? A lot of jobs out there will pay a salary to their members if they're on, or to their workforce if they're unable to work. It's a great perk to have. Absolutely make sure that that you understand that within your own company if you do have it. If not, this may be an avenue that you should consider. Each company has a list of illnesses which all differ slightly. There's around 80 to 90 illnesses and most covered. However, the majority of claims are for heart attack, stroke, cancer, and neurological conditions. So it can be something that, you know, there is illnesses that obviously fall through the gap or the cracks in terms of saying, well, will this illness be covered? It's not an exhaustive list, but in general, if you're talking about the name as a giveaway, I suppose, serious illnesses, there's a good chance it's going to be covered under the list here. One tip I would say in terms of serious illness cover, whatever you do, please don't wait to get ill before you attempt to arrange this cover. There's a chance you won't be able to get it. In my career, I've consistently met customers who have said to me they want to take out, we'll say, a cover like this. And when we meet them and discuss their needs, it turns out that there have been some sort of illness that's just come to light in the background. It makes securing this type of cover so difficult. So it's very important to consider that if you're healthy or if you feel that you know you're not suffering from a recent illness like that, it's a good time to consider it. Another type of cover which is very relevant, I think, to people working in office-based jobs would be income protection cover. So the way income protection cover is a policy that will pay out a replacement income if you're unable to attend work due to accident, illness, sickness, or injury. Now, this policy is always arranged on a sole life basis, so it's arranged for one person only, as opposed to the other covers which might be arranged on both a sole or a dual life basis. Typically, this type of cover is arranged with what they call a deferred period. So the insurance company mean by that is it's a length of time that you must be off work before the payments will actually start or kick in. This can be as long as 52 weeks, but it's often set as a lot lower on an 8 or a 13-week basis. So for example, you might have employment where someone will say to yourself, okay, if you're working in my company, we'll pay you for the first 13 weeks that you're off. After that, your income will stop. That's where income protection would kick in, perhaps in that situation, and replace your income. Now, the good thing about income protection cover is that if you're in receipt of a payment, it will continue until you're able to return to work or the policy matures. So in terms of being able to return to work, generally speaking, that comes down to medical evidence. So are you actually certified as being able to do your work? If you are, well, then your income protection cover ceases at that stage. If not, it will continue on. So there would be clients of ours in FBD who would be in receipt of long-term income protection cover. They may have had some sort of serious injury or illness at a certain point in their career and have been unable to return to work. In that situation, the income protection cover has kicked in and is paying them a regular income. Now, in terms of income protection cover, ask will your employment type qualify for the payments. So what I mean by that, certain manual and labor intensive jobs won't. For example, hod carriers. I doubt there's too many hod carriers in the ESA, but just use it as an example. If you're in an office-based sedentary role, it's ideal cover. It's an ideal cover for you in that scenario. There's no prescribed list of illnesses in this one, so it will pay out for things like stress-related absences or back pain, time off for surgery, etc. So you don't need to worry about an illness. Is it on a list as such? It does no prescribed list in that scenario. So it's a lot more wide-ranging. Essentially, if income protection cover is available and can be applied for, it's a superior cover than serious illness cover in that scenario. Now, as I said about serious illness cover, I really mean about income protection. Whatever you do, please don't wait to get ill before you attempt to arrange this cover. 100% won't get it. Underwriting is more difficult for this type of policy. It does become it's a stringent set of underwriting rules from an insurance cover point of view. So it's important to recognize that if somebody has some reasonably poor health, there's a very there's a likelihood there that secure and income protection cover won't be available. Now, any good advisor, if you're sitting down with an advisor and talking to them, they'll be able to tease that out with you probably long before you'll actually make an application for cover in terms of talking to underwriters. We'd also have lists in terms of saying, well, what type of illness it is, and it gives us indications of whether cover is available in that. So it's important to share that information with your advisor, and by doing that, they're able to then give you a steer as to whether this type of cover is the right one for you. One of the great benefits, or one of the great features of income protection cover, should I say, is that tax relief can be claimed on the cost of cover. So let's say, for example, your policy premium is €100 per month. The way that works then is that you get tax relief on that policy premium. So it'll only if you're paying tax at the higher level, you'll pay €60, where the €40 will be offset against your tax that you would pay otherwise. So the government obviously have recognised the importance of this type of cover and are prepared to put their money where their mouth is in terms of advocating it as a cover that people should consider. Important to recognise proof of income is required to claim. So there's no point over insuring. Whatever income that you have, that's the income that you should be seeking to insure. 75% of the current salary is allowable for cover purposes, and if applicable, income tax is paid on the claim. So if you are in receipt of money from an income protection cover, and the money that you're getting from the claim has gone into the tax bracket, you will pay income tax on that because it's treated as an income, but it's still obviously far better than just relying, we'll say, on state benefits alone. So I want to finish off this presentation here just with a couple of, I suppose, my 6 biggest tips for getting the right cover in place. And these are just 6 tips. In my years, I worked in the last 12 years as a financial advisor in a number of different companies. And over the years, these are the sort of things I've picked up, which I feel are very important in terms of getting the right cover for any of my customers. First one, make use of a broker for value of choice. The right financial advisor can research the market on your behalf, get the best deals and all available discounts, and explain the nuances of the cover. So if you're going to be in a situation of taking out a long-term policy where you're going to part with your hard-earned money on a month-to-month basis, I would emphasize the idea of talking to a financial advisor and getting them to research the market using the information that you provide to them, because that's the information that's so important to get the right type of product and the best fit for you in terms of the policy that you should be looking at. The advantages that brokers have, obviously, is that we're able to go out to the market in general, talk to different insurers and research on your behalf. I think that's worth its weight in gold for people, because you can be in a situation then of you can have clarity knowing that you're going to get the best cover that you possibly can in that scenario. Reviewing your policies. If you have a protection cover in place and you haven't reviewed it, you should. In my experience, it's a really worthwhile exercise. And I really mean that. Over the years, I've spent a lot of time reviewing people's policies, and it falls into lots of different categories. Even something as simple that you could say to somebody, we have looked at your protection cover policy, reviewed it, and you know what? It's brilliant. It's fit for purpose. It's doing what you're asking it to do. It's good value for money. Keep it. Stay with it. That's some of the great advice we can give customers. Other times we might talk to them and say, well, look, I really suggest that you would relook at this as a choice for yourself, because I don't think it's fit for purpose at this stage. But by reviewing existing policies, that I find it so worthwhile for our customers, and we really get great value for them out of it. Engage with a proactive financial advisor. So a lot of times you'll see people might do a financial product with a financial advisor, and that's it. You do the product. bought and sold, if you like, at the time. Information is given, and it's very transactional in that situation. I would not advocate that as a way to do my financial advisor business. To me, if you're not getting at least one phone call every 12 to 18 months from your advisor, you're not getting the service you deserve in that situation. I would say also, if you have multiple financial products, if they're with one financial advisor, you stand a far better chance of enhanced level of service. So it stands to reason if you have 2, 3, 4 financial products. Sometimes people say, well, I'm going to spread them across a couple of different financial advisors so that all my eggs aren't in one basket. But I would take the viewpoint that if you have, a significant level of business like that with one person, you have a far greater chance in terms of them giving you the service that you deserve. So I'd be expecting a phone call, as I say, every 12 to 18 months from my financial advisor. Mortgage protection cover should be a basic form of cover to pay off the mortgage outstanding in the event of death. Any additional money you're going to spend, put it into a cover where the payout is going to go to you or your next of kin, not the bank. So really think about what mortgage protection cover is. It's there to provide an ability to clear your mortgage if you die. That's it. That's what mortgage protection cover was initially designed for, and in my view, that's what it should be for. A lot of the time, people might add on bells and whistles to the mortgage protection cover, so that, say, for example, serious illness cover and a few other enhanced benefits in relation to it. If your budget allows to do that in the context of having all your other protection needs sorted out, yes, absolutely no problem in relation to that. It's good advice. But I would say to anybody that it's important to see any money that you pay into your mortgage protection cover, if that policy is assigned to your bank, they have first call over that policy. So it's important to say to yourself, okay, am I comfortable with that as a situation? Am I better off having a basic cover that protects the bank's interests while using the money that I've left over for a policy that maybe is going to come to me if I'm unlucky enough to have to make a claim? Another thing I'd say, put a continuation option guarantee cover again, any standalone life cover or serious illness cover policy you set up. Now, I've talked about this already, but I can't emphasize it enough. I think when the policy comes to end, you'll be able to take out a new policy without providing any new medical evidence. So you'll have complete peace of mind if a medical issue does rear its head. Useful thing to have. You might never use it. You might roll around to the next policy and be every bit as healthy as you were beforehand, but it's important to recognize the fact that having that continuation option gives you the peace of mind that you might need. And lastly, in terms of tips, if you're not sure about any aspect of your cover, ask the advisor. It's what we're here to do. I would think for anybody in this business here, that's what we're looking to do. We're looking to engage with our customers, and we really want to make sure that we're offering them the right financial advice. So if you have any questions or queries, pick up the phone, ask the question, and you'll find out very quickly then the mettle of your financial advisor. Okay, folks, that's my presentation over for this part here. So I'm going to hand you back over to Odell now.
Thank you very much, John. And there's plenty of food for thought there. There's some good questions coming in on the chat function. So if you have any questions to ask John, we'll bring them up at the end. Just pop them in the Q&A chat function at the bottom of your screen. Next up, I'm introducing John Lowe. He's the money doctor. And if John Mulholland, if you stop sharing your screen there, we should be able to switch them over. So John Lowe, as some of you may have seen his books in bookstores, are yellow and they have the money doctor written in front of them. He's a qualified financial advisor and a fellow of the Institute of Bankers in Ireland, as well as a personal insolvency practitioner with over 35 years experience in the finance arena. He founded his own company, Providence Financial Services, aka the Money Doctors, which is based in Stillorgan, County Dublin, and that was founded in 1999. The company is a fully operational financial advisory agent dealing in mortgages, pensions, investments, and insurances. So without further ado, I'm going to hand you over to John Lowe, and he is going to talk us through the topic of mortgages, among other advice. So over to you, John.
Well, hello and good evening, ladies and gentlemen, and thank you very much indeed, Odile. I'm going to just hold on a second. There we go on that. That should be. Can you see that?
Not yet. No. If you try to share your screen there.
Oh yeah, sorry. Go back again. Oh yeah, beg your pardon. That's right. Sorry, to share screen. Now we do it. I beg your pardon. Now, there we go.
That's working there now.
And then we do that. So first of all, I'd like to thank you very, very much indeed for inviting me to present to you, members of the Agricultural Science Association. I'd like to in particular thank Odile Evans, because it was she who contacted me in the first place, and also Barbara McGoldrick, who has been the behind the scenes person who's been doing everything really, and also even your president, who's Anne-Marie Butler, because as I said to her today, this evening, it's the second president I've seen on my screen today. So I am, as I say, John Lowe. I'm a qualified financial advisor. I'm the founder and managing director of Money Doctors, which is a fully regulated and kind of authorized financial advisory firm. I'm also, by the way, a fellow of the Institute of Bankers, a personal solvency practitioner, and also have a diploma in company direction. But this presentation is primarily for first-time borrowers. It is only going to be 15 minutes as well, I might add. It's for first-time borrowers, it's existing borrowers, and also for switchers. So it's basically anybody who's thinking of a mortgage, whether you've got one or whether you've had one or whether you want one or it's the first-time one. And essentially, as I said, I'm going to use the acronym TILE because each letter has a particular relevance, and you've got terms and rates for the first thing, which is basically the term itself is up to now 35 years. 15 years ago, it was 40 years you could get, and interest only actually for 40 years. It was a brilliant time 40 years ago until the crash came. Also, then maximum age is 68. So if you want a 30-year term, you'll have to be 38 or less. If you're running your own business, you could go to age 70, which is another 2 years. So you've got a choice of two rates: standard variable rate or fixed rates. Like, for instance, these are the best standard variable rates at the moment, and you can see there the less you borrow, the lower the rate. Fixed rates, for instance, there are some absolutely fantastic fixed rates out there at the moment. 60% loan to value with one particular lender is 1.95%, and that's for a 7-year fixed. If you wanted an 80% loan to value on a 5-year fix, the best rate is 2.2%. So you can see that you can get some really, really attractive fixed rates. And these are going to be, by the way, long term. There's no sign of any rates movement upwards anytime soon. So there are 10 lenders in Ireland, and they're all buying for your business. As I said, that we have virtually agencies with all of them. I for income is part of the TILE, and that is all lending is based on the ability to repay. So if you have £1 million, euro even, property, and you want to borrow €100,000, unless you can prove that you have the ability to repay that 100,000, you won't get the loan. So for instance, multiples of annual income, that includes 3.5 times your joint annual income. Now, for some professional classes, the banks are given an exemption, and they can go up to maybe 4.5, maybe 4.75 sometimes, depending on your employment, because you could be in a position where you're inevitably or inexorably going to go up to a much higher income. So you've also got bonuses over time. They can be taken into consideration, but you must be permanent and you must have passed your probation period. That's generally 6 months. So another important part is ICB.ie or the Central Credit Register.ie. They are two credit agencies who they have about 140 odd credit companies who are with them, all the banks, all the credit unions, all the various other kind of, even a building society like EBS, they're with them, and they send them information on your loans. And if you miss one loan, for instance, you are gone for 5 years. You won't get a mortgage. You won't get a loan. So you've got to guard your good name. And if you have a judgment against you, it could be there for life. So you can write to either one of those two. It's free. You go to icb.ie, give them your name, your address, and your date of birth. And 4 days later, you'll get a report, and you'll be able to check to see whether you are okay or not to proceed to a mortgage. L, as part of the TILE, is loan to value, and the loan to value for first-time buyers is 90%. There was a time you get 100%. In fact, I remember organizing 110% for one particular client. That was 15 years ago, though. Second-time buyers, 80%. And then residential investment loans, 70%. So you've got, as I say, expenses then on top of that. Stamp duty, 1% over under $1 million. If you're buying properties, say, with 1.5 million, well, the 500,000 is at 2%. And the 1 million is still at 1%. So it's not aggregated. It's anything over $1 million is 2%. Legals, that's, you know, conveyancing your property, is 1% usually of purchase price plus VAT plus outlay. So the VAT at the moment is 21%. What I would do is I would always shop around, because you will get some legal firms, solicitors, who will want your business a little bit more hungrier than the next. Valuation fee, about €130, unless you need a structural report. Sometimes if the house is over 100 years old, you'll need a structural report. And the basic furnishings, you're talking about, you know, white goods, bed, you know, your TV. So you're looking at about 5,000 in my view. And of course, your deposit, which is the 10%. So that all should be part of your thought process if this is your first time. And even if it's your second time, you'll still have that. So then the Help to Buy scheme. Now this is for first-time borrowers and first-time buyers. So that was extended there only during the summer for new home or a self-build. So you won't get second-hand property with this. And it's essentially, it's not a grant, it's a refund of the tax that you've paid. So you get up to 10% of or 30,000, whichever is the lesser. And essentially you've got to live there for 5 years. So this is a new property. I was actually looking at a property in Bettystown, which is a magnificent golf course beside it. And this particular house cost 299,000. It was a 3-bedroom semi-detached house. And if you were a first-time buyer, you could get the full 10% deposit free, basically, as long as you've had the 4 years previous to that. It also applies, by the way, to properties less than $500,000, but you must have paid income tax or dirt tax. There's virtually no dirt tax at the moment over the last 4 years. So if you wanted that 30,000, then you're looking at 7,500 a year. You should have paid tax to warrant that 30,000. And then to start the process, you've simply got to complete a property information form online through your Revenues My account. So what else? You've got to need a good savings record. You've got to have a permanent job plus past, as I say, that probation period. You've got to have 6 months good current account statement. So meaning no referrals, unpaids or blips, because they look at all your transactions. And, you know, a referral is where somebody's gone to your current account because you've either were going to go overdrawn and therefore they needed to check to see that you weren't gone AWOL, but they still apply that referral fee. A referral fee is not a good sign. The same for credit card statements and loans. So again, you'll want to be paying it off. If you're just paying the minimum amount every month, let me tell you, it's going to take you 20 years to pay off that credit card balance, whatever it is, if you're just paying the minimum. So not a good thing either. So you do your own personal budget as well. So I'm going to actually stop the share there because I'm going to show you another little trick here. Do that again, share screen, and it's there. This is an absolute godsend that you should be doing this every January. And it's a very simple spreadsheet where it shows you absolutely everything, all the categories. It tots itself up. But more importantly, you can put the notes there on the right. You've got electricity, that's a 2-month bill. Your TV license, for instance, is 160 a year. So if you're doing this properly, it's a monthly budget planner. So you're going to put €13.33 there in where it says TV license. Now you don't have to worry about it because that's going to be paid out of your monthly net income. So your child benefit, €140 a month. By the way, you have a child benefit. If you do have a child, you're getting €140 a month from the time the child is born. It stops on the 18th birthday. If you just put all of that money under the bed, you would have accumulated €28,560. You are still 14,000 shy of sending that same child to third level education. So that's all about planning. So you've got all of their telecoms, mobile costs, your health insurance, mortgage protection, everything, motor expenses. You might have 2 cars, you know, family, the whole lot. You've even got, you know, church donations there, cosmetics, hairdressers, everything is there. You can, even if you don't have any pets, you could wipe that like category out and stick in a category that may not be in there and just put it there, because it's a spreadsheet, so you can put it all there. So you've got club memberships, you've got entertainment, everything is absolutely there. So it's going to tot itself up at the end, and you'll then know whether you have a surplus or a deficit. If you have a surplus, it means now you can plan. If you've got 500 or 1,000 a month, then you put that away. If you've got a deficit, you've got 3 choices. You've got to earn more, you've got to cut costs, or you've got to prioritize. And that is why over the last 5 years, 300,000 people stopped paying their health insurance because they prioritized. They needed food on the table sooner than paying their insurance. So I'm going to stop the share again there, because I'm going to show you another thing as well. Let me see, share screen. And this is actually, if I find it, where are we gone? Oh dear. No, it's not that. I was trying to find this. Where is that? You can't see that. No, I don't know why I can't bring that on, because it's not showing it. Show all windows. There we are. Oh, beg your pardon. Right. First of all, there is the Ireland's best deposit rates, and you can see they're absolutely pathetic. There's a guy, I think, called Jerry Walsh, who wanted to know about 50,000 to 100,000, you know, short-term kind of investment. Well, the very best on a fixed rate would be Ulster Banks for 12 months, 0.2%. I mean, even, you know, the 10-year National Solidarity Bond by NTMA, 16%, it's still only equivalent, if you can wait that long, to 2.31% per annum. So it's all pretty awful in terms of rates. But there is, I'm going to stop the share again there, and I'm going to show you one last thing on this share screen, and that is, if I can find it again, where does it say? Oh my gosh. Not that, it's not that, it's gone. No, I'll go back to it. I'll go back to there. It was actually 2 apps that I wanted to share with you. And these 2 apps are free. One is called our own one called Money Doctors, and it tracks your spending. Very interesting app, as I say. So you do it for 4 or 5 weeks, calendar month. And at the end of it, you press a button, you get a top 5 spends, total amount you spent, and geographically where you spent every cent. But you're for tracking your lattes, your pints, your newspapers, your magazines, your petrol, all of that kind of stuff. I had one guy who came into me. He said he had to have 3 lattes a day. I said, 3 lattes a day? Do you know how much that costs? He says, I don't care how much it costs. I need 3 lattes a day. And he said, I said, well, that's going to cost you €2,000, €2,000. And for you to earn that, to guzzle coffee for 1 year, you're talking about 4,000. So I said, as long as you're happy guzzling coffee for a year and you've no other priority, then go ahead. But you need to be aware of it, and say someday you might decide, I'm going to have my bedroom transferred into a nursery. It's going to cost 4,000. I haven't got it. What am I going to do? Stop guzzling coffee. So you're back to those kind of things where you have to know precisely where is your money going. You go to an ATM, you take out a couple of €100, and a week later you haven't a breeze where that money's gone. It's a great way of tracking it. The second one is called Stowcard, and that's for putting all those discount tags that you put on the key rings onto one app on your phone. You'll always have your phone with you. So as I say, the budget part is extremely important, because remember, it's you who has to pay that mortgage. So anything else? Yes, some insurance. John has already spoken about that life cover on the mortgage in case you happen to, anything happens to you or your partner. And the thing about that is, if you're over 50, you can actually get it waived. And if you have some health or medical issues, they may also waive it as well. You know, obviously they don't want you to be paying a fortune for life cover, you know, if that's what it is. Buildings insurance, again, in case anything happens to the house, and also contents insurance, insuring those golf clubs, the precious jewelry, and any items over 2,000. I mean, you wouldn't want to say to your partner that we don't need to insure the jewelry because it's not over 2,000. You might have a little bit of a problem. You should also have, as I said, about 5,000 for furnishings and white goods you will need when you move in. So what do you do now? Well, you go to our one-stop shop. And what we have is the mortgage. We have most of the agencies. We've actually all of the insurance agencies for life cover. And we can also organize buildings and contents insurance, and all at no cost to you, because all these providers pay us a fee at no cost. And even if you went direct, it's the same thing, except we will take care. We'll do the running around for you. So we normally have a Zoom consultation initially, and you fill out a fact find, and there are the numbers as well on that. So what I also do then is I have this little 10-step to kind of process where you transform your finances. Very simple, really. Have an emergency fund. I reckon you should have between 3 and 6 months rainy day money. That's 3 to 6 months of annual joint income, net joint annual income in a rainy day fund. And it's for 3 reasons: for your emergencies, like your clutch might go, sudden loss of income. You might be, asked to only work 1 day a week. And then the investment opportunity, saving for your deposit on your house, paying off expensive personal loans and debit credit card debt, short-term savings for cars, income protection. John has already spoken about that. It's very important. And also even life assurance. I mean, some of my clients who used to smoke, for instance, and they have a mortgage protection, and they were off a year, they came back, and that same policy was now 50% cheaper. So starting the pension, in my opinion, it is never too early. I think I was quoted in a national newspaper there about 8 months ago for a young lady who came to my office. She was only 26, and she wanted to talk about pensions. And by the time I had finished talking to her at 40 minutes, she was visibly upset at the idea that she had actually missed out on 2 years pension contributions. That's the way to have it. Buying a house with the help of a mortgage, budgeting and planning annual expenditure from earned income. That's so important. That little spreadsheet, really important to do once a year at January, because your circumstances change every year, no matter what happens. Your children get older, things happen. You have to then plan. It's all about planning, protecting your assets and possessions, and building up your personal investments and planning long-term care. So knowledge is power. And what I say is inform yourself. You read and you attend seminars and webinars like this to improve yourself. You understand the jargon. On my website, moneydoctors.ie, you've got a jargon buster. And every kind of term you've heard of that you're not quite sure about is on that jargon site. Spend time, at least 2 hours a month. You will be surprised how much money you save by just using those 2 hours to look at your own finances. Enjoy planning, saving, and spending. And then be positive and hopeful, because no matter how bleak things are, there's always hope. So 48 hours. What is that 48 hours? The 48 hours I put up there because I've been speaking now, I think, for the last 15 minutes, as I said I would. And if you, the audience, do nothing in the next 48 hours, then you're not going to take any notice of what I've been saying for the last 15 minutes. So I implore you, even go to your local advisor, set up that budget account, do something, or start a process, start a dialogue on your mortgage. That's my email address. That's my office number. Thank you very much indeed. Very much appreciate your attendance here tonight. Thank you.
Thank you, John. That was an excellent overview, and I've already had people asking me where can they access that Excel sheet. So we will be able to circulate that afterwards, and the slides from the presentations will be available on the website as well, both John Lowe's slides and John Mulholland's. So I will bring back in John Mulholland now to go through pensions, but keep the questions coming in, folks. There is some good questions in there, and we will get to them. We'll do a 10-minute Q&A session at the end. So over to you again, John.
Odell, thank you very much. Hopefully you can all see that. Okay, so now, so I am going to do a little piece then on personal pensions. So I just want to go here. Okay, so in terms of pensions and all that goes with it, what I'm looking to try and do here now is the whole idea of talking about what the point in having a pension is and why is it so valuable. John's already mentioned there as well in terms of pension policies themselves, the fact that they're so such a useful thing to have. And I want to just get to the right screen here. Yeah, so in terms of the policy, in terms of personal pensions themselves, a couple of different things here: retirement pensions and personal pensions. They're a savings plan. Normal retirement age 60 to 75. So for most people, when you're in a receipt or you're going to get your pensions between the ages of 60 and 75. So for whom is a pension? Now, I'm well aware of the fact that a lot of ASA members probably are working in companies, and they may have a situation there where their company is making a pension contribution on their behalf and they're members of the pension schemes. If you are, terrific, that is something that's very important. If not, a personal pension is something that's absolutely vital for yourself, because in terms of a personal pension, that's for anybody who's self-employed, in partnerships, or employees not included in an occupational pension scheme taxed under Schedule E. So it's very important to mention the fact that pensions, you must have a net relevant much of a source of net relevant earnings. Not all earnings are relevant for personal pensions. So essentially stuff like, we'll say rental income, for example, wouldn't be applicable in that situation here. So it's important to recognize the type of income that is applied. There's tax advantages to a pension, huge tax advantages actually. There's tax relief on the contributions paid in. There's tax-free investment returns and retirement lump sum as well when you get to the point of actually accessing your pension. So we take each of those, your tax-free relief on contributions paid. So when you're paying your money into a pension, the government will give you tax relief on that contribution. So for example, you're paying €100 a month into your pension and you're paying tax at the 40% bracket, the actual net cost to you is €60 in that scenario. The other €40 is paid back to you, or sort of say offset against your tax normally payable in that situation. Another piece about pensions in terms of tax advantages is the fact that the investment returns are tax-free. So not only are you in a situation where your pension is going to hopefully go up in value, but you're then going to be in a situation there where you're going to be, if your pension goes, if the investment piece is increasing in value, there's no tax in that. So it's in a situation then that if my pension has the good luck to go up by 5% in a year, I don't pay any tax on that return. So the tax relief alongside the investment return that's the real kicker. That's the bit that really generates the return for your pension over the long term. The last piece in terms of tax advantages, or one of the last pieces, is the tax-free lump sum. So when you get to the point of drawdown on your pension, you can withdraw up to €200,000 tax-free, depending on circumstances, depending on the value that's in your pension, and a few other caveats associated with it, but that's the maximum tax-free lump sum. In terms of the next question, how much can I pay into my pension? Well, there's different relevant amounts depending on the age that you are. The government has set percentage-wise. Now, these are relevant to, we'll say, somebody who's working as a sole trader or is an employee. For executives, people who own their own limited company, there's a whole different stratosphere in terms of how I pay into my pension and whether the company can pay in on my behalf. But if we look at, we'll say, for example, somebody who's working as a self-employed agricultural scientist, we look in that scenario, then we'll take someone who's between the age of 40 and 49. They can put 25% of their net relevant earnings into a pension and get tax relief. So if they're paying themselves €100,000 a year, €25,000 of that can be paid into their pension, and from that then they will get the tax relief for that amount. So if I pay in my 25,000 in that situation and I'm getting 40% relief on that, the actual cost to me is €15,000. So I've paid in 15,000 out of my own pocket. It's worth €25,000 in my pension. And then on top of that, I'm hoping for investment returns, which are tax-free in relation to that as well. So, nothing but good news about pensions, really. In terms then of tax relief, you need to obviously submit that to the local inspector of taxes. If you're really filing tax returns and you're using an accountant in that situation, they'll be able to help you in terms of reclaiming the tax relief on your pensions. Relief can be backdated to the previous tax year, and it can be spread forward to future tax years as well. So tax relief is quite easily claimed, and it's something that's the revenue are very, very used to people doing. When can the benefits be taken in terms of my pension? Well, normal retirement age is between the ages of 60 and 75. That's when most people, and in fact, That's when, you know, you should be really aiming towards, if you're setting up a pension, you're saying to yourself, okay, that's the time when I'm going to actually access this money here. Early retirement on grounds of ill health is allowed. I always say to my clients, I hope we never have to actually trigger that for yourself, because when I say ill health, it's something that's quite serious in that situation that will allow you to access your benefits before the age of 60. So anybody going into saving into a pension, I would really say to them, have the mindset that it's going to be 60 plus before you access it. My own experience as well is that when somebody gets a little bit older and the closer they maybe get to the age of 60, you'd be surprised actually the pension age or the age that they're going to access that money starts to push back out again. So we seem to spend maybe a good chunk of our early life waiting for the day that we can stop working, and then when we get a bit older, we want to be keep doing it. So benefits, how can the benefits be taken? So up to 25% of the fund is taken as a retirement lump sum. So maximum funds, so revenues have a set of rules in terms of not only the contributions amount that you put into it, but also then what the funding that you can fund for your pension. So the maximum fund at retirement is €2 million at the moment. That's what a person is able to save into their pension pot and get tax relief on. The maximum tax-free lump sum is €200,000, and you can withdraw a balance of up to €500,000. So what I mean by that, if you take 25% of €2 million, that's obviously 500,000. The first €200,000 of that would be tax-free. The next 300,000 would be taxed at 20%. So it still would make sense in that situation for somebody who was paying money at the higher tax bracket to avail of that at a retirement point of view, because it's only a 20% tax as opposed to 40%. In terms of the money left over, the 1.5 million in this situation, what does the person do with that money? Couple of options. Generally speaking, the purchase an annuity, a guaranteed income for life, take as a taxable lump sum, or invest in an approved retirement fund, or ARF. Now, I'm going to go through each of these here so you just have an idea of them. In terms of annuity, this would have been the traditional way that people would have drawn down their pension. So it would have worked for a long number of years, had an amount of money built up in their pension at a certain point in time, and retired, we'll say, at 65. So at 65, then the money would be calculated as a certain amount, and they would give that money to an insurance company, and the insurance company would pay them an amount of money, an annuity in this situation, for the rest of their lives. The idea of the annuity then is that it's a guaranteed income for life. There's lots of different nuances with the annuity in terms of how it's structured. You can pay it as, for example, a single life or guarantee period. We'll not get too caught up in terms of those there at the moment. With relation to annuities themselves, the market has changed somewhat over the last number of years, because with insurance companies paying annuities, what they relied upon is the ability to take that money and put it into something that was going to give a guaranteed income, because the guaranteed income obviously needs to be paid back out to the person in the form of the annuity. What's happened over the last number of years is that that sort of stuff has really declined. So guaranteed and you know, bonds and interest rates have gone through the floor, so to speak. So it's meant that annuity rates that are on offer from insurance companies have declined very severely over the last couple of years, aligned to the fact that people are living longer as well. So it's meant that people are in a situation then of, when they look at their annuity rates, instead of maybe getting 5% or 6% a year on the money that they've given the insurance company, it might have dropped down to maybe 2 or 3%. So it's become a less attractive option over the period of time, albeit it's a safe option. So that has to be mentioned. The ARF option is something Charlie McCreevy, if anyone remembers that man, he was the Minister for Finance back in the late 90s. So ARFs came in on his watch. The idea of this was then it was in an investment vehicle as opposed to a guaranteed income. It was an investment vehicle owned by the individual who owned the pension. So the way it works is that the money was put in as a lump sum. So if you had €500,000 after you received your tax-free lump sum, you put it into an approved retirement fund. The money that grows in there, it grows tax-free. So it's still the same as your personal pension on the way in. It's growing tax-free as it's in there. It's also and once you were to die, the beauty of the ARF is that it can be passed on to dependents. So if I'm a married couple, one of the problems people see with annuities is that they might only receive money for a period of time, and then if they're unlucky enough to die, some of the money that they've saved into that annuity is kind of lost in that scenario. Whereas with the ARF option, the money is transferable. And remember, from husband to wife or wife to husband, inheritance tax-free in that situation. There is a couple of caveats in terms of the ARF. One of the things is that you must have a guaranteed income for life of 12,700, which in fact the full state pension actually is worth that now at this stage. So if somebody has that or is in receipt of the full state pension, so we'll say they're 66 plus at this time and of 12,700 euros, all the money can go into an ARF. And essentially what that means is that once the money's in an ARF, you can withdraw the money out of it as and when you want. Withdrawals are subject to income tax if applicable. PRSI won't apply once you hit over the age of the pension age of 66. USC rates will change as well, depending on your other incomes as well. So it's important to sit down with an advisor who knows what he's talking about when it comes to ARFs and the withdrawals associated with them as well. I'd spend a lot of time with my clients trying to talk about the right time to withdraw money out of it. If you don't have the 12,700 euros per annum, or you don't have more than 63,500 euros, it goes into what they call the approved minimum retirement fund. It's invested in that. There is limitations in terms of your withdrawals from that. You can only withdraw 4% a year. So it does restrict that money somewhat in terms of how it works. But as I said, if you're in receipt of the full state pension, the full amount can go into an ARF. Now, how much income? The classic question, isn't it? You need significant money to fund your lifestyle. So let's say, for example, the question that on everybody's lips when it comes to pensions, how much money will I need at retirement? Well, if I have, say, for example, a salary of 60,000 euros per annum, a recognised approach is 2/3 of final salary. So that'd be 40,000 euros in that situation. How do I go about getting my 40,000 euros is the question. Well, the state helps, obviously, in that they pay the state pension. This says 12,131, but it's actually gone up since that. I think the state pension is something, as I said, around about 12,750, 12,800. So they will pay that. Your 40,000 euros then needs to be made up from the remainder. That's a big shortfall, obviously. The other thing about state pensions is that the qualifying age, well, it was scheduled to go up from 65 to 68 over the last number of years. The government put the brake on that recently and said that they weren't going to change it. It was supposed to go to 67 from this year. However, I don't know whether anyone's seen, there's a man called Charlie Weston who writes in The Independent, and there's actually a pension forum going on at the moment that's at government level, talking about the state pension and about how sustainable it is. There is a recognition there that there's going to be a huge shortfall in state pensions as the years go by, because what's happening is, as a population, we're getting older, which means that there's more people claiming pensions and less people actually out there working, which means that from a state contributory point of view and being able to actually fund the pensions, it becomes very, very difficult. I think actually this year, for the year that they've stopped and not changed it, that was a cost to the Exchequer of something around about 400 million euros for that one decision. So if I was a betting man, to me, the state pension, the government's going to get it hard to reduce it or take it away, because it's very, very powerful in terms of a tool for keeping everybody on side when it comes to voting time. But I cannot see for the life of me how the qualifying age is not going to go up and up and up. That's the only way it can be anyway sustainable in the long term. So in a nutshell, I suppose, in terms of funding for the pension, responsibility for funding your retirement really lies with yourself. If you're in the lucky situation that your company is making a contribution on your behalf, brilliant. What I'd say in that scenario is, the next time it comes to a discussion in terms of salary or increases like that, I'd review my pension with my company in that situation as well. See, well, what contribution are you making to my pension? Can that be upped? Would they be amenable to that, as opposed to just give me an extra 1 or 2% of my salary? You can top up your own company pension then with what's called AVC, so that's additional voluntary contributions. That allows you then the ability to increase what's going into your pension, which may help bridge some of the gap. So I suppose what you might be looking at, if you have a company pension, a personal pension, or other income, it's all about this piece here. How do I bridge that? And I suppose in terms of pensions, I would always say the fact is, everybody's taking into account other assets that they may have, land, property, so on and so forth. But it's all about really saying to myself, in a truest form of the word, when I get older, what income am I going to use to live off? The tax incentive to sales, so we've gone through that. There is very generous tax relief on your pension contributions, tax-free lump sum, tax-free growth. There's also a possibility of tax-free regular income retirement, depending on your overall income, especially as a married couple. A married couple can have 36,000 euros a year once one person's over the age of 65 and pay no income tax on that income. So as somebody gets older, that is the sort of things that needs to be taken into consideration. But rest assured, the tax incentives are there to save in relation to the pension. The last thing, I suppose, in terms of the pension piece then as well is how much and when should I start? So the sooner the better, really, in that situation. You can see here I've done 3 different examples, one for a person aged 30, another for a lady aged 40, and one for the gentleman who's hit the age of 50. And you can see each month, if they wanted to get 27,869 euros a year to bring it into the 40,000 euros income that they require, this man here would need to save 450 euros a month, which would be 270 net. This lady would need to save 880, and this man here is up in 2,000 euros a month. So even after tax relief, that's 1178, which is actually my mortgage on a month-to-month basis, 1,178 euros. So I don't know if I'd be fit to pay a second mortgage, being honest with you at the moment. But what I'm trying to say here is that the earlier you can start, the better. The more you can contribute, the better, obviously, for your own circumstance going forward. But it's really a decision that you need to make yourself. It's a commitment, a financial commitment like any other financial commitment, except there's tangible rewards and benefits in terms of it for yourselves with regards to saying at the end of this, there is money for me. I could possibly be inheritable to my family as well if going forward. But it's important to recognize the tax environment that's there in terms of the benefits that's that side of it. And also then in the background, what's going to happen to pensions in the future and how we're going to actually fund the pensions that we've committed ourselves for. I would be of the opinion that everybody would need to make sure that if they can at all, that they have their own fallback plan in place, because I think it's going to become a difficult conversation as years go by. So this hopefully is some sort of indication in terms of where you would need to go with your pension funding over the next couple of years. That's my presentation over. I'd just like to say thank you very much for listening to me. I'd be happy to answer any questions that you have now coming forward as well. And I'm going to hand back over to Adele at this stage.
Lovely, thank you very much, John. If you could stop sharing your screen there, and if the two Johns could switch back on your cameras for the Q&A session. I don't know how anybody else is feeling, but I'm slightly terrified and facing reality at the moment. But I do know John Lowe has a particularly hopeful story to tell us about our first question. And this one came in from Jerry Walsh. She asked, I would be interested to hear from the panel on their suggestions for low risk investment options for sums of 50 to 100,000 euros right now, as the banks are now charging fees to hold such funds. So what options would you propose? And I'll put that to John Lowe, please.
Well, I can tell you, it depends on the length he needs to lock that away. I mean, if he wants to get access to it within 5 years, then the very best asset class of them all, which is the stock market, is not for him. I was regaling to you before the start of this about a gentleman who was actually made redundant last May, and he had 40,000. He was only in his early 40s. So he had to think about what he was going to do, but he didn't want to spend this money. So he stuck it into prize bonds. Now, prize bonds, there are 3 things about it. Number 1, you can't touch it for the first 3 months. Number 2, once the 3 months is up, you got to give 7 days notice to take it all out. But number 3, it's guaranteed by the government. So he was very happy about that. But also he knew that from day 1, he was in the draw. A week later, he won $1 million. So he was one of the lucky ones, who got that. I had actually 2 prize bonds many years ago, and I got it as a result of selling these tickets, and I then won first prize in this draw £200. And I asked my mother, what should I do with it? I was only 22 or something at the time. And she said, oh, put it into prize bonds, so I've got two. I was that miserable in those days. I got two, and I even wrote the two numbers in my diary. And so I was looking at, and this tells you how old this is, the Evening Press. And in those days, they had the kind of the draw of the prize bonds on the latest news on the front page. So I saw the first four digits of this particular day, and I saw Y710. I said, my God, that's very near my number. So I opened up my diary and I looked at my number and I looked at that number. It was the same number. I won £1,000. Now, just to put it in context, I bought a 3-bedroom detached house in Rathfarnham then, and it was one of the biggest sites on the development, and it cost me £14,575.
Wow, so the £1,000 went a long way towards that.
But no, what to do with that? As I say, the stock market certainly is the best. But you've got all those NTMA, the National Treasury Management Agency. They're a body it's a government body, and it's guaranteed by the governments, as prize bonds are. But they've got the three ones: is the National Savings Bonds, the National Savings Certificate, and the National Solidarity Bond, which is a 10-year investment. And you get 16% into your fist at the end of it. It's guaranteed, and money is guaranteed. The maximum you can put into is 120,000 per person. So the only thing is, though, if you went to say Bank of Ireland and said, here's 100,000 or AIB, give me 116,000 in 10 years time, because they have to deduct dirt, which is 33%, they'd have to give you a rate of 2.31% gross each year. And that is the very, very best rate on the market in terms of deposits. So, I mean, there's other forms of alternative investments, from rock and roll memorabilia. If you ever came to my office and you opened the door, on the wall of the, immediately as you open the door, is a jacket framed. It's one of 25 jackets that were made for a film called Great Balls of Fire, Jerry Lee Lewis. And I happened to be invited to his 60th birthday party in Memphis. And his wife, who I knew, gave me the jacket. And so that was, as I say, 25 years ago. And so I wore it the second day. It's a black Lee denim jacket with a embroidered piano on the breast pocket. And I even got a badge on it which said, help, I think I'm a rock star. So the second day I wore the jacket, the wife came up to me and she said, hey, John, that's a collector's item. It's worth $5,000. And his wife, and he's not even dead yet.
So I guess we can all go buy jackets. It depends on how quick we want the cash at the end of it.
You can get into all sorts of art, numismatics, which is coin collection, philately, stamp collection, all sorts of things. The buzzword really is diversification, but it just depends what Jerry Walsh wants to do with that money in terms of, has he got family? As I said, it's 42,000 to send one child to third level. Yeah, that could go very quickly if you have two children.
We've got lots of questions, and just to say to all the attendees also, the this webinar is being recorded, so that it will be made available afterwards, because lots of people asking for the slides at the moment. John Mulholland, I'll come to you with the next question. What is a good level of serious illness cover for the typical family with 3 kids, assuming mortgage and other normal outgoings?
Okay, so yeah, it's a good question. In terms of your 3 kids, I suppose the things to consider for that are, what's my workplace benefits? So do I have any workplace benefits that will pay a replacement income for me, or are going to pay out a serious illness if something like that, it does occur to me? Outside of that, I would look to see then my existing mortgage cover as well, what cover is on it. So if I do, or if I am unlucky enough to get a serious illness, will my mortgage be paid off in that situation? If we'll take, for example, both of those aren't applying in that scenario, and I've got 3 kids, you really should be looking at, standard practice would be, you could say cover the mortgage plus 2 years salary and work your way back from there, I suppose, is a lot of time what people would consider. Time frame then wise, you would need to take into consideration the age of the children. So for most people, it used to be 18 when children kind of flew the nest and so on and so forth. You can nearly put that to 28 at this stage, between people doing PhDs and further education, and all that goes with really embedding themselves into the working structure. But certainly for most of my clients, we would say, for anybody, look, you've really got to consider your children 21, 22, 23. So if my youngest kid is, for example, 8 years old, and I'm saying 23, that's a 15-year term. So those are the sort of ballpark figures you'd be considering in that scenario. One last thing I would say in that, if I was doing a serious illness cover in that situation with somebody, I would say review your life cover in that scenario as well, because you might get some better value combining the two together, but it really takes a holistic view to see if that's actually the way it works.
Okay. 2 questions on mortgages for John Lowe. First of all, who is the best mortgage lender at the moment, in your opinion? And secondly, if you pay a lump sum into your mortgage and you need to decrease your mortgage protection policy, do you get a new policy, or does a decreasing level continue on the existing mortgage protection policy? And that could be both Johns, really, but we'll put it to you first.
Well, okay, the best mortgage lender, there really isn't one, because it's really down to you know, what suits you and your particular circumstances. You know, if you go on rates, like the very best 7-year fixed rate, which is the best rate in the country, is 1.95. There's nothing lower, and that's fixed for 7 years. Best 5 years 2.2, best 3 years 2.3, believe it or not. So you know, it depends on what your situation is. Most people they might go to an intermediary and they'll ask to, you know, get a whole raft of you know, approvals. I don't believe in that, because you're wasting at least the other people's time as well. But I know instinctively, for instance, where for instance, some companies like Ulster Bank, they will take on bonuses. Other banks may not. There's other little nuances like that you need to know. So you couldn't really define a mortgage lender as saying who is best. It is who has the best appetite, perhaps, for your mortgage, and that might be more appropriate. As regards, you know, mortgage protection, and then, you know, reducing your mortgage. I mean, mortgage protection is where the balance of your fund, of your mortgage, is reducing on an annual basis, actually a monthly basis. And therefore, if you die any time during that period, it's what the balance of the mortgage is. So if you pay off a lump sum, you can actually go back, if you want, and look for a lower premium, but it's a new premium. You can't get the same policy. And that would probably,
starting from scratch as such,
yeah.
like, yeah.
But actually, you might be better off leaving it as is, because I think, as John mentioned before, if say you die and the balance of the mortgage protection is higher than the actual balance, well, your estate will get the differential.
Okay. There is actually a lot of questions coming in on that, and the next one is related to mortgage cover as well, for John Mulholland. Life cover to cover a mortgage. Should we change to a life assurance to have something at the end of the mortgage if there's 18 years left on a mortgage?
Well, I think I earlier on in my presentation, what I said to that was that my advice for mortgage protection cover is to do a basic form of mortgage protection cover to protect the bank's interest, because in that scenario there, what you're trying to do is say to your bank, okay, I owe you 100,000 euros, for example, there's 18 years left of my mortgage. As that 18 years goes through, what I'm owing you is going to decline all the time. So a decreasing term mortgage is going to take care of the bank's interest. My own view, aside from that, then, is that if you have a budgetary amount left over, a standalone family cover is a better option in that scenario, because what you'll have then is the money coming directly to you in that situation. There's no third party involved in terms of the bank. And I think it's a lot cleaner from that particular set of circumstances. So my advice to that person would be, have a basic form of mortgage protection cover that protects the bank interest, and possibly look at the idea of having a secondary policy that what I term a family cover. So it's protecting me and my family if something happens to us.
So if you're paying over the odds, that it's benefiting you rather than the bank, as you say.
Yeah, well, I suppose in that situation, you know, you have to say to yourself, well, what is my overall budget for my protection needs, and then how do I align those monies as best I can? If my budget is absolutely to the minimum, well, I need to do a mortgage protection policy by and large, because that's for most people the primary concern. I don't want to face the problem of not being able to pay my mortgage if something happens. But outside of that, if we're in a situation where budgetary features allow, I would certainly say have a standalone family cover then, because you know then you have peace of mind.
Okay. Another one for you, John Lowe. Typically speaking, how much would a financial advisor cost, and when should you go to one? Should it be a year before applying for a mortgage or sooner?
Okay, well, as I say, if somebody came to me looking for a mortgage, The actual mortgage, itself is free, but I do consultations whereby people come and they get a review. So what I charge is like a doctor. If you go to your doctor, you're going to charge, be charged 65 euros. And the average time a doctor actually spends with his patient is 7 minutes. So we do a 20-minute Zoom for 65 euros, but usually the very first one is a 40-minute Zoom, because you look at the entire, when you go to a doctor, you've got a sore arm, he's going to look at the rest of you and say, are you okay? So you'll do a full review of your health. We do a full review of your wealth. And so for that, as I say, it is essentially, a look at everything about you, your savings, your budgeting, the whole lot. And then after that, they came back and said, okay, we want to do a mortgage. That's free. All those kind of, you want to put in an investment, that's free, because we will get paid by the provider, but we don't have a bias. So like I said, we have all the insurance agencies. So it's where the best deal is for the client, what suits that client best.
Okay, makes sense, and you get your financial planning going as well. Very good. We have another one coming in from someone who possibly didn't log on to the Revenue Online system earlier this month. Is everyone working from home? What or how do you claim a tax credit for same relating to COVID? Which of you would like to pick that one up?
Well, they're claiming for COVID already, are they? Is that what it's saying? So they're
well, I guess I know there's tax credits for bills like broadband and extra heating, etc.
There's a €3.20 per day allowance that is being given to people who are working from home, and you claim that through your tax office. The COVID payments themselves, actually, there's 420,000 people who got bills there in the last week. And some 23% of them will be paying about 500. 14% will be paying over 500 to 1,000, but 47% of that 420,000 people will pay nothing. So it's not a whole heap, because even if you were paying 350 euros on a pandemic unemployment payment from day one of last year, from the first week, and you got it right throughout the entire 52 weeks, that's still only 18,500. So, you wouldn't even be hitting the income tax at that level, but you would be hitting universal social charge. You don't pay PRSI, because even though you are still credited as if you have paid PRSI, so your stamps would be okay. But the universal social charge is payable. But for a lot of people, they would have been working from January to March, and therefore they would have already had income. And that then adds to their overall taxation for the year. And then when the pandemic payments then are put on top of that, that's where this extra taxation is due.
Yeah, and I guess in terms of claiming tax credits, it is about logging on to the Revenue Online system and uploading bills and that kind of thing too.
Yes, my account. Revenue's my account is what you do. You need your PPS number.
Yeah. Perfect. This is for John Mulholland. If you're a young person, 29, and paying contributions through work, semi-state work, should you be paying into a private pension as well, or is it a waste of time?
Well, in that situation there, you'd need to have additional private income for that scenario. For a lot of semi-state workers, what they'll actually have the facility to do what's called an AVC, which is an additional voluntary contribution. Most of the semi-states as well will actually have that facility organised through their payroll, so it can be done by payroll deduction. I know, for example, with teachers and the company Core Market would work quite with a lot of them as well, and offer that sort of facility. In terms of whether it's worth the while paying the money into it, then the first thing you want to be checking out then is, well, how many years have they done? What sort of service will they have built up at retirement? But traditionally, what a lot of people would do with their AVC facility is that they would pay money into that in order to use it to maximize a tax-free lump sum at retirement. And then they can use the money that they're going to get from their AVC pension, from their semi-state pension, to provide their income in that situation. So that's how I'd approach it. I would assume there should be some sort of HR department through their work that might put them in touch with their core market or whoever their official is in that scenario. That would be my first protocol.
But if you are farming on the side as well, ultimately you can set up your own.
That's exactly it. If you're in the farming game, like myself, I have a farm at home and I make tax returns each year. Yeah, absolutely. If you have Schedule D income that you're working for yourself, no problem. Away you go. The one thing to consider in that situation then is that you have to make sure that your tax affairs are in order, obviously, and you do your tax returns. But as part of that, then you can make a contribution to based upon your farming income.
Okay. And I think this is pensions as well. Is tax relief automatic, or do I need to apply for it?
Well, in the tax relief point of view, from the point of view of, we'll say you're an employee, most tax relief is done at source then in that situation then. So if I'm in this receipt of a monthly salary, the accounts department within the company itself will have organised the tax relief and what goes with that. Never any harm to do a revenue online balancing statement then as well, just to request that to make sure the tax affairs are correct in that scenario. Outside of that, if I'm in a situation where I'm a self-employed sole trader, well, and I'm doing tax returns, well, I'd be looking for my accountant to handle the revenue online piece then as well, in order to make sure that my tax credits are in order in relation to pension contributions.
We're going to take 3 more questions. 2 are related to pensions again. Can you transfer any savings policy with a bank into an existing pension or a new pension with the same institution or a different institution?
Well, in terms of the savings piece there, so it's very important to recognise the difference between a savings and a pension plan. So if I have a savings plan, for example, an old SSIA that I'd saved into for years and I built money up in it, that's money that's you've saved in what I would call after-tax income. So I get my salary each month and I pay some money into a savings account. That's different from a pension policy. So if, for example, I've worked in a bank and then I moved to work in a different institution like FBD, I may have had a pension in my bank that I've built up over a number of years, and I would have the ability to transfer that into my current employer if I so wished. That's one of those things that there's a big industry around that at the moment in terms of people who have, we'll say, significant monies built up in a pension and have left that employment. What is the best options to do in that scenario? I would suggest sitting down, if that's the kind of circumstance that someone has, I would say sit down with a financial advisor and get the lowdown in terms of what your best option might be.
There's a question here on the savings for college for children, and I think, John Lowe, you said yesterday that if you put your children's allowance away from birth, you only end up with 28,000 at the end, and the first year in college costs about 45,000.
Right, you're actually, it's 42,000, and the 28,560 is the cumulative total of the child benefit from day one up to the 18th birthday when it actually stops. I mean, there's lots of saving kind of accounts that are available on the market. However, the deposit ones are not that attractive because they're getting very, very, like you have a regular saver account, the very best of them is Ulster Bank's 0.85%, and that's before dirt tax. What I would prefer, I mean, a number of the insurance companies do these regular stock market saver accounts. Like Zurich have a very good fund called Prisma funds. So you can save between 75 and 2,500 a month with them. And you can do that, for the first 5 years, there's not even clawbacks there. With Irish Life, they have a fund called MAPS, Multi-Asset Portfolio. Good thing about them, they have a little safety mechanism that in the event things go pear-shaped economically in the world, the funds that are in the higher aggressive funds are automatically switched to the lower, more cautious ones. So the minimum in that is 250 euros a month. So, I mean, it's ideal for somebody like over any 10-year period, the stock market is always going to win out. And as Warren Buffett said, the stock market is a mechanism for transferring wealth from the impatient to the patient. So as long as you've got a 5-year vista, and that 5-year vista would be, you'd have no penalties, no withdrawal penalties. You take any withdrawals within a 5-year vista for a stock market investment, and you'd have a penalty maybe of up to between 5 and 1%. So, but over 5 years, there's no penalties. So it makes absolute sense on a longer term basis to put money away in a regular stock market saver account than say just the ordinary regular saver account or the post office. That would be my view.
It's interesting you mentioned Warren Buffett, because anything you hear in him speaking, interviewed anywhere, is really, really interesting to listen to, and it was well worth it in terms of stock markets.
I'll tell you a little bit about him, because he in 1958 he bought his house, and that's in Omaha, Nebraska, and it cost him $31,500. Today he's still living in that same house. That's 62 years later, and he's paying more in property taxes than he paid for the house originally in 1958.
He's an interesting guy. One more question on pension for you, John Mulholland. I have a UK pension. I'm now backleading in Ireland, no longer contributing to this pension as I started Irish pension when I returned. Should I bring my UK pension back to Ireland now or leave it in the UK until I retire?
Yeah, great question. Again, that's one of the, there is a whole, again, industry that's built up in relation to that. There's a couple of questions, I suppose, back in terms of that is, is it a private pension? Is it a company pension? Is there, for example, guaranteed annuity rates or so on and so forth identified with the existing pension? And what's my current situation in terms of what pension I'm paying into at this time? So it's just not a simple yes, no answer, but it would be something that I would absolutely get advice on. Sit down with an advisor, get the tease it out in terms of what my current situation is. I have seen quite a number of people doing that, moving their pension from UK back into Ireland. It can take a bit of work to do. Zurich, I find, are quite useful in that situation. They have the best facilities in my view of doing that. But I would take financial advice in that scenario. Would be my how I would approach it.
Okay, excellent. That's it. I hope we asked all the questions. Thank you to the two Johns. Anne-Marie, I'll hand it over to you just to close us out there. Thank you.
Okay, thank you very much, Odile. And sincere thanks to John Lowe and John Mulholland. I'm conscious it is gone 9:30 and numbers stayed really strong on the webinar. So thank you to everyone who's tuned in from home. I think a couple of very quick takeaways for me. Certainly, look, we're all locked in and locked down, and at home everyone's busy with lots of things going on in houses. But I think if we take from John Lowe 48 hours, I think if we can do something within the next 48 hours to review so much that has been detailed there, I think we'll all do a very lot. It's been a most enjoyable event, I have to say. Lots of smiles as well as lots of very valuable insights. I think when I look at a lot of the information from John Mulholland, some of those topics can make for some difficult conversations in families, but certainly those are conversations that are very worthwhile having, and never a better time to start that conversation than now, and just to think for the future and just protecting the interests of those who are behind us. And I suppose with my banker's hat on, I have over the years unfortunately seen where families have been left short and things have happened. So I think it's a very opportune time for all of us just to look at our own scenarios and our own situations and what we can do for all families and for all that are associated with us. So look, at this point, as I say, I thank everybody. Thank you to Odile for chairing and for her tremendous organisation of this event over the last couple of weeks. The recording will be available. We'll hopefully getting up on our site tomorrow. So do keep an eye on social media and you'll see when it's up there, and certainly to use those 48 hours. For everyone, stay safe and stay well and stay in touch with the ASA. And thank you. Sleep well.
Thanks.